Hello and welcome to a new video about Texas Instruments stock analysis. Texas Instruments, a dividend investor stream, dividend increase since 17 years, I think, and dividend yield of more than 2%. And we are making a deep dive into Texas Instruments fundamentals, if the stock is still a buy or not, because if you bought the stock, for example, 5 years ago, then you made capital gains of more than 200%. I can show you how much. And we will look into the secret of the success of Texas Instruments, and we will see if this success story is still intact. And I think to many of you, there will be a surprise, maybe even a bad surprise. But first, look at some fundamentals, some metrics. And here you see, if you invested 5 years ago, capital gains of more than 240%. And for many dividend investors, this stock is very attractive because of dividend yield, more than 2%, already not bad. But here, years of dividend increase, 17 years of dividend increase. We have compound annual growth rates, average yearly dividend growth of 22%, 23% within the last 5 respective 10 years. So these fundamentals make the stock really shine. So make the deep dive into Texas Instruments. By the way, my name is Thorsten Tiet. I'm the founder of Dividend Stocks Cash. It's about growing dividends. It looks like that, growing dividends and capital gains. And capital gains, they look like this. This is capital gains. And anything of that you got with Texas Instruments. But is it still a valid story? We will see right now. The management tells us that their objective is to increase the free cash flow per share. This is exactly what we can see here. This is the free cash flow per share. And we see that starting in 1999, management succeeded so far. Okay, next thing. Which levers, which ways management has to increase the free cash flow per share? Is 3 ways to go. First is to increase sales, revenues. Second one is to increase its margins. Third one is to make share repurchases, because this metric is per share. Let's go one by one. Here we see the revenues, sales, and this might be disappointing because in 2006 we had revenues of 40.2 billion US dollar. This is more than we have right now. So there is no earnings growth, or earnings growth, yes, but no revenue growth at all. It's complete stagnation. And if we look at the earnings and free cash flows, or also operating cash flows, then we see that there's no stagnation, but there was a rather nice increase in 2006. Earnings per share 1.71 US dollar compared to nearly 3 US dollar, so about 3 times more, while sales, there was a complete stagnation. How is this possible? We still have 2 ways to go to increase these per share metrics. One is margins. Let's add the margins, show them, and then we see that starting in 2006 we had, for example, gross margins of 51%. Now we have 63%, 12% more, and let's get rid of them. And then you see, for example, if we focus on net margins, 80.5% but 36%. So they doubled. Net margins even doubled, which means that finally $1 US revenue is in 2000, or 1 US dollar revenue right now is worth twice as much as it was in 2006. And obviously this correlates to higher earnings. Correlation, let's see, and I think that it becomes clear that there is a very strict correlation between the margins on the one hand and between the earnings, as we can see here, on the other hand. So if margins go down, earnings go down. If margins go up, earnings go up. And this is a very, very strong correlation, also strong correlation related to cash flows, both free and operating cash flow, because they correlate with the earnings as well. And this is the main driver. The margins are the main driver for increasing earnings and cash flows. And how did Texas Instruments succeed to increase their earnings? Earnings also, but especially their margins for as long as 2 decades already. And one reason for this is customer focus. So they are focusing on automotive and industrial customers on the one hand, which is also a reason something which is not as nice, because these industries are cyclical in nature. And there you see that we have revenue decrease, for example, not starting due to the corona pandemic, but already started before. But the customer focus is one reason for higher margins, and the other, more for the recent years, reason is the technological advance. The wafers got larger from 200 millimeter to 300 millimeter, and we have here the presentation of Texas Instruments, and they say that if they increase the wafer size to 300 millimeter from 200, then the gross margin increases by about 8%. And now in the next slide they say that in the end of 2019, last business year, they already produced about half of all their analog chips using 300 millimeters. So there is still 50% to transition to 300 millimeter, which means right now they should be, if these numbers are true, between 60 and 64% gross margin. And if you look here on dividend stocks cash right now, they are very close to the 64%, 63.1%. But that also means that the gross margin can't be increased up to 100%. They are already very close to the end of what is possible, which means that this gross margin increase basically or nearly already came to an end. They started with 32% at the bottom, up to 63% right now, and the absolute maximum, as we can see here, should be 68%. So we don't expect much from increasing margins anymore for the future. And if you look at what analysts expect, they don't expect really growing margins. Here we have the operating margin, and right now 40%, they think up to 43.5%, but I don't think there is much more possible, and they don't know how they estimated this, but in 23 they expect a drop in margins, a drop in earnings, and a drop in revenues as well. But that's absolute glass balls. But what is important is they can't continue the next decade to increase the margins as they did the decade before. And what's also interesting is the net margin. Here you see a jump. That's the US tax reform in 2017 by Trump, which made net margins jump by about 12%, about 12%, 11%. It was a boost for the earnings as well, but it's only a one-time boost, so don't expect anything to come like that once more. So that's rather bad news. It was bad news for revenues, because revenues did not go up. There is just a stagnation, and now we might also expect more or less stagnating margins on a very high level, but stagnation anyway. Remains lever number 3, which is share repurchases, and this is, you can see here, and really Texas Instruments is relying heavily on share repurchases. Since 2005, number of outstanding shares reduced from close to 1.8 billion outstanding shares in 2004 to 930 million. So they nearly halved the number of outstanding shares within 14 years. And doing so increases the per share matrix. You can see it here. This is the increase of the earnings per share each business year by share repurchases. So within 2019, for example, 20 US cent, and the organic growth was minus 55%, and without share repurchases it would have been minus 75 US dollar, not percent, not US dollar, but US cent. 75 US cent loss or decrease of earnings per share without share repurchases. Now only minus 55 US cent, because 20 US cent gains by share repurchases. And does this can Texas Instruments continue like this? The answer we can see here if you look at the balance sheet. And here we have, by the way, the treasury stock, and here you see the pure amount, the total amount of share repurchases piled up on each other, up to 36.6 billion US dollar. And here you see that it started. They really began with relying heavily on share repurchases in 25, and here you see how it piles up. So it's a nice amount. Can they continue to do so? What's important to determine this? It's the amortization power. That's the free cash flow minus the dividends. Dividends they will have to continue to pay. And its free cash flow within the last 4 quarters was 5.2 billion US dollar. They spent 3.3 billion US dollar. For dividends remains 1.8 billion US dollar to make share repurchases, for example. And so you see there's still some room left, especially if we consider the cash in the balance sheet of Texas Instruments, which is 5.5 billion US dollar. And if we relate this to the total outstanding debt of the company, which is close to 10 billion US dollar, then half of the outstanding debt is already covered by liquidity. And then we have still this free cash flow, which largely exceeds dividends. So there is green light. There's green light for dividend safety. Dividends won't be cut. So there is no need to worry, and share repurchases will continue. So that's the good news. The bad news, as I said, is stagnating revenues, stagnating margins as well. If we put all this together, then I think something comes out, as we see here, more or less stagnating even on per share matrix earnings and cash flows. So here we had a nice years of nice growth, and now we'll face years of more or less stagnation, or only slight increases. This holds true, I think, for dividends as well. Nicely growing dividends here between from the start up to now, but then I think that the revenue growth will come down. We can also see here already expected dividend growth 7.5% only, in parentheses, versus more than 20% in the past. So this is a very mixed picture, and the crucial answer, still outstanding answer, if we want to know if a stock is still a buy right now or not, that's the valuation. And here we see, because if the stock is aggressively priced right now, if the stock is more expensive than it was in the past, and on the one hand, on the other hand, earnings growth, the dynamic will be lost, then we have a problem. If the stock is undervalued, clearly undervalued, then it still might be a buy. Also, we have a deceleration of earnings growth and cash flow growth. Here we have the dynamic valuation of the stock, and I already know that the period here is fits very well for the valuation, and we have more up to 4 parallel fair value calculations. I will show them to you one by one. And then we see here, I will zoom in a little bit more like that, and then we see here the different lines which indicate the fair value for the whole period, and then the black line, that's the price of the stock. And then we see that in the past the stock was fairly valued, which means that more or less fairly valued, which means that the stock price more or less respected the different fair values. Sometimes it was undervalued a little bit, the stock. Here it was overvalued, but it always came back to the fair value of the stock. Here you see the different metrics. So the historic price earnings within the last, starting in 2011 up to now, was 20.5, and based on the adjusted earnings 18.6, on the operating cash flow 18, and the average dividend yield 2.4%. And I get rid of this year where the earnings and so on will go down. I don't know if analysts will be right with that. It's a little bit too much glass ball in my point of view. And now we will zoom in a little bit more to focus on where we are right now. And here you see basically that the fair value dividend is very optimistic, fair value of close to $160, and the fair value based on all our metrics related to earnings and cash flows are much lower. In this case, if we have clear different fair values and the fair value dividend is much too optimistic, I get rid of it, because what really counts are earnings and not dividends, even if you're an income investor, because dividends are not sustainable if earnings and cash flows get lost or are not sustainable. So let's get rid of this. And then we see that the fair value is somehow between 100 and close to $120, depending on which fair value you take. But the stock price is $170. So the stock seems to be clearly overvalued. We have price earnings about 30, and based on the operating cash flow about 28, related to these historic metrics, like about 20 for the price earnings related to compared to 30, so 50% more, which indicates a clear overvaluation. And now we have this more or less, or this slowdown in earnings and cash flow growth, mainly due to the end of dynamically growing margins. And this, there's a contradiction, and this contradiction somehow must be resolved. Very high valuation, but declining growth of cash flows and earnings. And how can this be resolved? In two ways. Either analysts, and me included, are wrong, and somehow margins increase more as we thought, and or revenues increase more as we thought, and as a result, earnings and cash flows go up much more than we see here. That's one way. The other way is the stock price is simply too optimistic. Mr. Market is simply too optimistic, and then he will have to come down in the near future, within the next 1-2 years, after he recognizes that he was too optimistic. And this means capital losses, for example, like that. Here you could see the fair value based on earnings, reported earnings, 125, close to $125. This means a loss of about 25%, capital losses mostly. And this is not a very nice perspective. So in my point of view, for me, it's more realistic that Mr. Market this time is wrong, as the analysts and me included, which means to me this stock Texas Instruments is not a buy, because it's simply too much overvalued right now. And I would be very careful. I would never buy the stock right now because of its overvaluation. Of course, it is only my opinion. I might be wrong. You make your own due diligence, but that's just my 5 cents about Texas Instruments. Okay, thanks for watching. It would be nice if you drop a comment below, if you have other opinion, if you have some additional information I forgot. Thanks for watching. See you next time. Ciao.